Okay, today we'll be talking about investing wisely in the capital market using hedging. All right, now what's the meaning of hedging? Hedging simply means an investment undertaken to reduce the risk of adverse price movements in a financial asset. All right, typically it involves taking an offsetting position in a related security, such as a futures contract. In essence, a hedge is intended to offset potential losses or gains from a companion investment. Simply put, a hedge reduces the risk of substantial losses in financial assets within the capital market. A hedge can be constructed using various financial instruments, including stocks, ETFs, insurance, favorable contracts, swaps, options, OTC derivatives, and future contracts. Hedging involves taking a position in one market to offset the balance against risk assumed in an opposing market or an opposing investment. All right. Now, what do we mean by using hedging in investment? First, hedging in investment is a strategy used to reduce risk by taking an opposite position to balance out potential losses. For example, if you invest 10,000 naira in First Bank shares, you can protect against general market decline by short selling 10,000 worth of a stock index that includes First Bank. If the market drops, your short position on the index makes money, offsetting the losses from your First Bank shares. You may be asking, what is the meaning of short selling? Short selling is an investment strategy where an investor borrows shares of a stock and sells them. Betting is trying to bet or gamble that the stock price will drop. The goal is to buy the shares back later at a lower price. Then you return them back to the lender and keep the difference as a profit. If the stock price goes up instead of going down, the investor will have to buy the shares back at a higher price, resulting in a loss. In the context of this example that we just cited earlier, where we say short selling 10,000 naira worth of an index that include First Bank, what really mean or what it means is that the investor is betting that overall stock price or the overall stock market, or specifically the stock index, which tracks a group of company including First Bank, will decline in value. Now, how does this thing work? How does it work? The investor borrows shares of the from the borrows shares of the index worth 10,000 naira, sells them at the current market price. All right. Now, if the market or the index declines, that is the prices in the market in the index, well, like the Nigerian Stock Exchange is an index. If the price declines, the investor can buy back the shares at a lower price, returning the borrowed shares and keeping profit from the difference. This strategy is used to hedge or protect the investor's long position in First Bank shares. If First Bank stocks fall due to a general market decline, the profit from short selling the index will help offset losses from the First Bank shares. Another common hedging approach is called pairs trading, where a trader buys stocks in one company, maybe company A, and simultaneously short sells stocks in a weaker company, company B, in the same industry. For instance, if the trader buys 1,000 shares of company A at 1 naira each and short sells 500 shares of company B at 2 naira each, of course, the total value is the same because you have 1,000 naira apiece. If positive industry news raises both stocks, all right, company A might rise by 10%, earning an additional 100 naira, while company B rises by only 5%, causing a 50 naira loss on the short position. However, If negative news hits the industry, both stocks could fall. But since company A is stronger, its losses might be less severe. This reduces overall risk because the gain from short selling company B can help offset the loss from holding company A. In simpler terms, the investor is trying to make money from the drop in the overall market to balance any potential losses in their specific stock holdings. We've been using the word index. What do we mean by index? An index is a collection or group of stocks that represent a particular market or a sector of the economy. It is used to measure the overall performance of that market or sector. For example, the Nigerian Stock Exchange All Share Index tracks the performance. In short, we actually call it the Nigerian Stock Exchange All Share Index, NSEASI. This particular index tracks the performance of all the listed companies on the Nigerian Stock Exchange, giving investors an idea of how the market as a whole is doing. So, what are the advantages and disadvantages of hedging? Let's start with the advantages. Number one, lower risk of investment. A hedge significantly reduces investment risk by offsetting potential losses. Number two, flexibility in investment options. What does that mean? Hedge funds can use financial instruments beyond the reach of mutual funds. Number three, best managed investment funds. What does that mean? The flexibility and the hedging strategy is hedge funds help manage investment risk effectively. Number four, market exposure. Hedges are popular with companies exposed to specific markets like commodities or interest rates. Number five, less volatility. Hedge funds are generally less volatile than individual stocks. Now, disadvantages. Number one, higher minimum investment. What does that mean? Hedge funds typically require high minimum investment, making them accessible only to wealthy individuals and institutions. Number two, higher risk. Hedge funds often take higher risk to generate returns, increasing the likelihood of losses. Number three, lower liquidity. Hedge funds are less liquid, simply means limiting investors' ability to buy or sell instantly. You can't get your cash back quickly. Number four, mispricing. Hedge funds management determines prices, leading to potential mispricing and investor losses. Number five, short selling and margin calls. This carry high risk of losing money. Number six, low regulation. Low regulation. Hedge funds are largely unregulated, increasing the risk of unfair practices and misinformation. Number seven, lower risk management. Hedge funds often lack robust risk management, making them vulnerable in financial crisis. And number eight, high fees. High fees. They pay high fees. High hedge funds charge high management and performance fees, reducing your return if you invest in them. Number nine, selection bias. Management selection bias. Management may selectively report only the best performing funds, misleading investors while trying to avoid to report the less performing funds. All right. Today we've talked about hedging in a strategic as a strategy for mitigating losses in large investments. It acts as insurance, protecting against significant losses, but it can also be a waste of money if not judiciously used. That's why taking decision to hedge, you should consider the specific situation and cost of the hedge. In some cases, a hedge is essential for financial stability. In other cases, it may reflect an uncautioned approach. All right, today We've talked about the meaning of hedge. We've talked about using of hedge in investment, its advantages and disadvantage. If you want to know about investment, I think you should look at the videos we've made about investment. If you want to talk about venture creation, if you want to learn more about venture creation, we've done a video on venture creation. And then on diversification, try to watch that video on diversification. In our next session, we will be talking about investing wisely in the capital market using arbitrage. Thank you for listening.